There we go. Well, welcome everybody. Thank you so much for coming, and thanks for watching if you're going to be watching this online. My name is Tyler Davis Jones, if you don't know me. And I am with Adam Hestad as my business partner. We're with the Rise Seattle group at Compass. So Compass is a nationwide brokerage for real estate, residential real estate. And then we are a team within Compass. So Adam and I joined forces in 2021 at the very beginning. And we're just building a team. Our goal is really to provide the best, most world-class real estate service for residential real estate. That's for buying and selling as well as investing. And our primary mission at the end of the day is just to help our clients, our staff, ourselves to dream big and to live our best lives. And so that's part of the reason we're doing this exact webinar. The whole purpose is to give information. We're not trying to tell you to be an investor. We're not trying to tell you to sell your property. We're just trying to give you the best possible information for you to be able to go after your goals and to live big and live your best life. So we are here today with Josh Breiling. Josh is my personal CPA as well as my business CPA. He's with Finney, Neill Company. They are on Finney Ridge. And he's probably one of the most prolific CPA conversationalists that I know. His depth of tax knowledge, as well as his ability to tell a story with tax is really, really awesome. And that's one of the primary reasons I wanted to have him on this webinar. To set a few ground rules. So one, ask that you stay muted if you're on the call. The second, and just so we can kind of get through the content, because it is pretty dense conversation, we will take questions at the end, but those questions also, we want them to be really 30,000 foot view. The point of this whole call is really to ensure that we're talking about a scenario and kind of giving you a baseline understanding of federal tax, capital gains tax. While, we could get into the granulars of like, I have this house, I owe this much, I want to do X, Y, Z. We'll just ask for you to table those conversations and take those to Josh offline. We also ask, like, Josh is graciously giving us his time and his knowledge for this call. So if you call him, just be expected to be billed, because he provides that service, and we highly recommend that you do that. So there we go. Looks like Rachel's coming in too. So one thing that we want to get out of the way first is we are not talking about Washington State capital gains tax, the legislation that just passed literally last week. We are not talking about Washington State legislation, capital gains tax omission. We are talking about federal, and there's two different types here, which I'm going to let the actual tax expert explain this a little bit. But just so you know, whatever is being talked about in Seattle Times, this has nothing to do with it, what we're about to discuss. So I'll let Josh kind of briefly hit on that here in just a second. And then we'll go from there. So why don't we just go ahead and get started? Josh, why don't you just briefly describe what the scenario is in the legislature right now in Olympia and what they've passed. This is not a political statement. This is just a factual statement, and then we'll go from there.
Yeah, the legislation that's in the state Congress right now, and did it pass? Last I heard, they were working on it, but I do know that they made some changes. But essentially, what we have here is it's being called an excise tax on capital gains. You could call that an income tax, probably, but potato, it sounds better if it's an excise tax. That's not going to apply to this conversation for two reasons. One is in the current bill, it is excluding gain from real estate. So the state tax isn't going to apply to that. So that, for the most part, is not going to affect our conversation about real estate. It is important. It's just going to be outside of our scope. But it could come into play down the road, potentially as you're considering options. So it's worth mentioning. It's out there, but we're just not going to get into the details of that today.
Great. Yeah. So getting started, one of the things you have to think about whenever you're going in and trying to decide whether or not you want to be a investor of some sort, right? We all have this kind of perspective of like, I want to build wealth with my real estate, right? In fact, I even think it was back Bill Clinton originally, he was kind of the originator of this American dream, that it's the American dream that everyone owns a home. And that has perpetuated this desire to even build wealth based off of real estate, right? So the question comes down to, what type of investor do you want to be? Do you want your first home that you have? Are you wanting to hold on to that house and then essentially turn around and sell it in 10 years? Well, if that's the case, that's going to dictate the decisions that you make. Are you wanting to maybe hold on to your current home, rent it out, and then use that money to maybe up level? It's called a 1031 exchange, and up level that into like a larger piece of property. Then that's going to dictate the decisions that you make here. So just know you have to answer that question first. What exactly are you trying to accomplish when you're looking to actually invest in real estate? That's the first question you have to ask yourself. And that will dictate whatever way you're trying to drive this decision. Because if you don't want to be a landlord of a multiplex, right, and that just doesn't seem like a risk that you're willing to take, then you need to pay attention to kind of what we're discussing as of right now. So we'll let Adam take the first question, and we'll go from there.
Yeah, thanks, Tyler. And Josh, thanks for giving us your time this morning and helping inform. We've got a lot of people thinking about this, I think, because it seems pretty attractive, at least from the onset. But I think it was enlightening yesterday talking with you a little bit more about it in detail and learning myself a little bit more. So, but if somebody's looking to sell a home, from a federal tax standpoint, what do they need to know? What do they need to understand as the basics for this?
Yeah, I think the great place to start is the mechanics of how a gain is calculated. And just want to make sure we all have the understanding of the baseline from income tax purposes. How is my tax being calculated? So first thing you're going to do is take your gross sales price. Then you're going to subtract your selling expenses. So that's going to be things like your broker fees that you pay or your agent fees, excise taxes to the state. Now, I know we had talked about what's in the legislation. What I'm talking about is there's an excise tax on the sale of real property. And that's not on the gain, it's just on the gross sales price, been around forever. Other selling expenses would be things like title fees or anything to effectuate the transaction. So did you pay for staging or for some photography? Did you do a little bit of work to your property to get it ready to show and to sell to get the best sales price? All that is considered a selling expense. You then subtract your gross purchase price. So that's the top line of what you paid for it, not your cash, but what you bought it for, the top line dollar. In fact, the most surprising thing to some folks is your mortgage does not factor in to your gain calculation. Typically, it's off to the side. And then you subtract out any substantial improvements you paid for the property while you owned it. Did you do a remodel? Did you put on a new roof? That adds to what we call your basis, and you subtract your basis from your sales price to get to your net gain. What's very specific for homeowners is if you meet this gain exclusion under Section 121, you can then subtract an extra $250,000 per taxpayer. So that's up to $500,000 for a married filing joint couple from your gain. And this is a pretty big deal. Then you get to your taxable gain. So those are the metrics, or the mechanics, of how you calculate the gain.
So explain to me, so what exactly is the gain exclusion, right? Because like we can kind of talk about this, and sometimes I know my eyes start to glaze over anytime. This is why one of the reasons I'm grateful for you to be here. Anytime you start talking about tax, I'm like, okay, sounds good, whatever. But explain to me the impact of this exclusion and what you're referencing.
Right. So it's basically one of the oldest and most powerful tax incentives out there that everyday Americans can take advantage of. The thing is it's not every year. It's usually only a few times in someone's lifetime that they do this, but it's very significant. So it's under Internal Revenue Code Section 121. The original version was created way back in 1964, and it's been modified since then. But there's three criteria you need to meet to be able to exclude up to $250,000 of gain, again, per taxpayer who qualifies. So there's three tests. The first one is the ownership test, then it's the residence test, and then it's the every 2-year test. So the ownership test is basically as of the date of sale. So it's usually your settlement statement, the settlement date. Looking back as of that date, looking back in time, 5 years. If you owned it for at least 2 of those 5 years, you meet the test. This is important for newlyweds. So if someone owned a home before and then you got together and lived there and then got married, this is where, because each taxpayer has to meet these tests individually. So we're not going to get into the details, but you have to have owned it. Okay. The second one is a residence test. Same 5-year window, looking back as of the date of the sale. Was it your principal residence for at least 2 of the last 5 years? Yes. Okay, great. Then it's the every 2-year test. Did you take this exclusion on any home sale 2 years prior to the sale date? And if the answer is no, well, then you qualify. And it's very significant on its impact. In fact, I think we have an example we can pull.
Yeah, let's pull up the example and see what that looks like.
Okay.
Because again, the showing, I think, is a little bit better than telling in this scenario.
Okay. Can you enable screen share, Tyler?
Or you should have it now.
Okay. Okay, you should all be seeing my screen right about now. Can you confirm?
We got it.
Okay, wonderful. So here we have an example. So we've got some base facts. I'm going to kind of put all the tax speak I just told you kind of into a framework here. Let's say you bought a home in 2016 and it was $600,000 back then. You put a 20% down, you finance the rest. And over the years, you've made $150,000 of improvements with outside cash, your own money. And we're going to skip this annual growth rate. We're going to come back to that. But let's say it is now worth $1.2 million. So let's say we're going to sell it now here, upcoming in May. So you've owned it for 5 years. You're married. You meet all the exclusion criteria. This is your only home. You lived in there the past 5 years. You've certainly owned it. And you've never sold another property before, at least, it's been a while. So you meet all 3 tests. So your gross sales price is the 1.2, that's your top line dollar. Then you have selling expenses. A general rule of thumb is about 9%, could be more, could be less, depending on how much work you do and the decisions you make with your agent on how you're going to, on your selling strategy. So then you get to a net sales price, just under 1.1. Well, you get to subtract your purchase price, so not what you paid, not the money down, but the top line price that you bought it for back in 2016 of $600,000. You also get to subtract those improvements you made over the years. There's this item here for accumulated depreciation. It's not a rental, or at least not yet in this situation, so we don't have to worry about that. So you have a net gain of $342,000. Well, you meet the gain exclusion, so the whole gain exclusion applies. You are left with no federal taxable gain. It's a great benefit. And then the sale, the cash flow on the sale would be, you have your 1.2 minus your selling expenses, minus that mortgage. I'm just going to assume it's $300,000 when you sell it. So you net cash of $792,000, roughly. These selling expenses and these federal taxable rates, just want to say that these are estimates. Federal rates, I do need to specify. Tax rates vary. Federal tax rates vary. This is just general education purposes only. Your facts and circumstances are going to be different. So shameless plug, consult your tax advisor. But this kind of shows you the impact of what the gain exclusion can be. Let's say it's $0. Well, all of a sudden, it's a $51,000 tax bill if you're taxed at 15% on those gains. That is a significant tax savings and a tax incentive for home ownership.
So to reiterate, you're saying with the $500,000 tax shield, you're saving. You said how much was it? $51,000.
$51,000, and this is only a $342,000 gain.
Right.
Let's say full 500 at 15%, that's $75,000.
Got it.
However,
Okay.
that's assuming that your federal tax rate, your capital gains rate is 15%.
Yep. And for context too, so the way you get this exclusion is just by living in the property. You're going to turn around and sell today, right? You're not looking to rent. You're just basically turning around and selling today. That's how you get this exclusion.
That's right. It's just selling your home. This is why, if you ever do some reading, that people like to do what they call a sit and flip, which is, I'm going to buy a property, it's a little run down. I'm going to improve it substantially while I live in it, and then I'm going to sell it. Well, because you've lived in it, and even though you've improved it significantly, it's shielded from federal income tax via this exclusion. So that's why that sit and flip model is fairly popular for folks who are pretty handy working on houses. But this tax rate's important just because your capital gains rates, it can be as low as 0% for very low income folks. The standard rate is 15%. That's what we're all familiar with. However, it can bump up to 20% on large amounts of gain over a certain amount. And you have to look at all of your gains, so not just your home, but if you sold, say, some stocks for some gain the same year, that plays into it. On top of that, there's this tax called the net investment income tax, and that starts kicking in on investment income over a certain level. That's a 3.8% tax. That's just kind of layered onto the top, and capital gains are considered investment income. So your capital gains rate can be 15 to 20, and you might have a 3.8% kicker. So depending on your situation, your tax rates could be 15% to 23.8%. So pretty significant. So it's a bit of a range, but we're not going to get into the details of all of that. We're just going to kind of use some general assumptions here for this example.
Josh, one quick question that's relevant to this. If you get this $342,000 gain here, to capture that exclusion, do you have to buy another home, or could you start renting then and still not be taxed on the 342?
It's a great question. You might hear from some folks who might remember the gain exclusion in one of the previous formats. You did actually have to buy a new home within a certain amount of time. You don't have to anymore. But let's say you want to keep your home. How does the gain exclusion apply? Well, you have to still meet those 3 tests. So essentially what you have is a 3-year window after you move out of the house, because that's when your principal residence ends, and you have to have 2 out of 5 years for that principal residence test. You still own it, but you have to make it your home, your primary home. So when that stops, you are starting a clock for 3 years. So in theory, you could hold on to it for a period of time and then sell it before that 3 years is up. In the tax code, though, it does say you need to prorate your ownership between your principal residence and non-residence use. And then you allocate that gain into 2 buckets. There's the years that you lived in it, or the days, it's actually days that you lived in it, that ratio, that's eligible for exclusion. But the portion of the gain that is not for when you lived in it that is not, the exclusion does not apply to that part of the gain.
Is that on the third year that you're referencing that it gets
Well,
prorated?
it's interesting because, and this is where a lot of folks get confused, including practitioners. This proration ignores the time you didn't live in it for the time after you moved out. So what you have is a 3-year window where you can get that full exclusion, and you don't have to consider that time after you moved out for this ratio that you do. But once you go, but you have to understand there's that 3-year, that clock is ticking. If you were to move back into it, or let's say you had a rental property you've owned for a very long time and you want to get the exclusion, so you move into it for 2 years. Well, okay, that non-personal use period is before your residence period, and then that's where the allocation happens for the portion of the gain that's not eligible for the exclusion. But it's really powerful because it can create a situation of a kind of like, well, if the market's doing really good and I don't want to sell right now, and all the factors line up to where I have the financial ability to not sell it right away, you have a little bit of wiggle room there.
One question we just got was, do you have to roll the gain into another home to get the exclusion?
You do not.
Okay.
You used to. Back in the day, there was a version of Section 121 said you did. You do not have to anymore.
So, but and we're referencing if you were to rent it, let's say you do decide to go that route, that is where you're going to have to roll it into another investment, which is what's called a 1031 exchange,
And
correct?
1031 exchange, yeah. And that is very nuanced. If you're able to do one, you should talk to, shameless plug, a tax practitioner to understand the tax mechanics of what's going on there and the potential for more tax down the road, maybe. Again, it's a long conversation. Then also to understand how to make the transaction happen. There's some very specific steps and rules you have to follow to make the transaction eligible. So that is an option for the savvy real estate investor at the 1031 exchange.
So Josh, let's bring it back to option 2 here, because I think that's what the people are most interested in. Like option 1, you own it, you move out, and you sell it right away. Option 2 shows by the end of year 3 after moving out, if you sell your home, you still get to claim this entire $500,000 write-off and the tax consequences of that. And then option 3 is showing if you held longer than that.
Yeah.
What does that mean? I think you gave a 5-year or 4 or 5-year option here just to show the difference between selling on year 3 versus selling on year 4. Can you just walk through those real quick for us to show the difference?
Yes, thanks for bringing that back around. So let's say we have a market growth rate of 4%. Decide this number for yourself. This is where we get into estimating. I'm not holding out anything saying this is what it is or this is what you should use. So
Josh, if we use market data, we actually ran this on a 15-year, and 5%, our original 5% that we had was actually pretty accurate. It was like 5.2% year over year gain. So yeah.
Let's do 5. All right. So let's say you move out May 1st of 2021. You rent it for a couple of years and then sell it 2 years later. So looking at that 2 of 5 year rule, as of May of 2023, when you sell, when you close, you step through the three tests. Have you claimed this exclusion within the last 2 years? No. Okay. Have you owned it? Well, yes, and they're stopped owning. That's never a question. Do you meet the 2 out of 5 year rule for living in it? Well, as of the end of 2023, you didn't live in it for 2 years, but you lived in it for the 3 before. So yes, I still do qualify. Well, excellent. So what you've done is you've captured the appreciation, 5% for 2 years. Let me walk through this sale transaction, the gain calculation. Minus 9% estimated closing costs, selling expenses, net sales price, minus what you paid for it originally, minus those improvements you did. We're going to add back accumulated depreciation. That's the depreciation on the property while it was a rental. And then you have a net gain of 491. The excludable amount is 453. The reason being is that depreciation, it's not eligible for the exclusion ever. So it does come back, and it's because you got a deduction for it while you were renting it. So then that has to come back as income. So you don't get a one-sided deduction like that if you sold it for more than what you bought it for. I'm just going to assume a 15% rate on this taxable gain for the depreciation. It could be as high as 25% on recapture. I'm not going to go there. It's a small amount. I'm just going to assume 15% applies. So you pay federal tax of $5,600 on it. Well, let's walk through our sell cash flow. You sold it for 1.3 minus our selling expenses. Mortgage balance of 287. I'm assuming that when you moved out in 2021, you refinanced it to recast the mortgage payments, lock in a low rate, and you put it in for 30 years. So your mortgage balance at this time would be 287. So your net proceeds is 916,000 minus the federal taxes you have to pay. Your after-tax cash is 911. It's $119,000 more than 2 years prior. Pretty good for 2 years on essentially keeping in 792. And I'm also assuming that with the rental that you're cash flow neutral. That essentially, after paying the mortgage and all the expenses with rents, that you're coming in at zero. So essentially, the value is in the rental is the increase in the property.
And I mean, estimating, let's say like a $2,500 a month rental over 2 years, you're looking at 60 grand, right? So that's kind of taking that into consideration.
Sure.
Yeah.
So if your rental is actually cash flowing positive, then you need to factor that into this, but that's just outside of scope of this discussion. So what happens if you decide that you want to hold on to it another 2 years? Let's walk through that. Let's say in 2025, you go to sell it. Well, it's now grown to 1.45 million. You have the 9% selling expenses, minus your purchase price, minus the improvement, adding back more accumulated depreciation because it's been a longer time that you've rented it. There's more what we call recapture. Here's your net gain. Notice there's no 121 exclusion. You look through, have you owned it? Yes. Have you taken the gain exclusion in the previous 2 years? No. But has it been your principal residence for at least 2 out of 5? No, because you moved out of it 4 years before. So you only have 1 out of 5. At this point, you do not meet the gain exclusion. It's in all 3 tests. So you just are stuck with a taxable gain of 651. At that point, I'm assuming you're going to probably be bumping up into the higher tax rates. So I'm just using an extreme 23.8% tax for this example. Total federal tax of $155,000. Let's walk through the cash flow. Same deal, gross sales price minus your selling expenses, minus the mortgage balance at this point. It's gone down. Is your net proceeds minus your federal taxes, you're left with 944. You will notice that's only $33,000 more than 2 years prior. So because you lose that gain exclusion in a significant amount of your profits is now having to be paid in tax, this is going to eat into your decision. Now, at a certain point, there's going to be a break even of when the continued depreciation beats the savings that are lost from losing the 121 gain exclusion, that opportunity cost. But usually, but you have to think long term in the future. So.
And this is really like this is the key point of of our time together today, to show like this 3-year exclusion is what matters. Unless you're thinking really long term about holding on to a property, it may not make sense. If you're thinking longer, like you said, Josh, at the beginning, or Tyler, it's a different conversation to be thinking about, right? But if it's a difference between year 3 and year 5, you have to start weighing the costs of being a landlord against a $33,000 gain difference in this example. And obviously lots of other factors in your cash flow costs and income and that kind of stuff. But in a general example, it may not be worth it.
Right. Because the question is, should I convert to a rental, right? The classic tax answer, and I'm going to stop sharing my screen here. I think we've seen the example. The classic tax answer is it depends for everything. But there's a wide array of factors you need to consider quantitatively. Do you have sufficient cash to purchase your new home? What's the financing going to look like? Can you afford to keep it? What's the growth going to be on the rental property? We were saying 5% in our example, but you might have a different opinion. And it also depends on the market that your home is located in. It's very important. What's the cash flow going to be on the rental? And is it appropriate for your needs or your expectations? Are you prepared to have a potential, big maintenance event on your rental property at any time? And potentially, just because when it rains, it pours, let's say your own home in the same week, right? Are you prepared for that? What's the tax impact of the rental going to be? Is there going to be a tax loss? Are you going to be able to use it? Is it going to be limited? We're not going to get into that for the purposes of this discussion because so much can depend on everything else that's going on in your return because it all kind of works together. The tax code's gotten more complicated over time, but just things to think about. At the end of the day, it comes down to how bullish you are on the local real estate market and what your long-term goals are, to kind of bring it back around to what Tyler said at the beginning. Eventually, usually you do come across a break-even point on foregoing the gain exclusion tax savings, but that has to fit into kind of what you're thinking about long-term for what you think what you want your finances to be or your investment mix to be. And quantitative items aside, and sometimes more important, there's the qualitative factors, right, that the numbers can't predict, but it's just on your own what works for you, which is, do you want to be a landlord? Are you prepared to have to make some hard decision that's going to drastically impact someone else's life, potentially? Are you prepared to do that? How much spare time do you have? And be really honest with yourself. How much spare time do you want to devote to managing this? And yes, you can outsource that management so you don't have to make those hard decisions and you don't have to lose that time, and you can hire a management company, of course. The going rate is about 10% of your rents. It's pretty high. And then coming back around to the quantitative, how does that work into that mix of everything we talked about, cash flow, tax savings while you own it, all of those things. I can't answer that for you. And to a certain extent, I can model some of it, but a lot of it just comes down to what works for you and coming back around of, what do you want out of life? What do you want for your finances? So food for thought there.
I mean, if I can kind of wrap this up in a bow, if you're still kind of kicking around the idea that you want to be a landlord, from what it sounds like, you have 2 years where you can test it, right?
Yeah. So my general advice is you can punt the decision. So maybe you're thinking through all of this, and if you're on this call, I imagine you are. Let's say you do think you want to try it out. Well, you have a 3-year window with this gain exclusion after you move out, where the gain exclusion can still apply. So my general advice for the folks that are really strongly considering it and they think it pencils out okay, after converting to a rental, is after 2 years after you move out, revisit the sell or hold decision. Because at that point, you have 1 year left in your 3-year window, and that's going to give you the time to plan and execute a sale. You don't want to decide this, 2 months up from it, because trying to get that thing prepared and sold with a tenant in it is going to be challenging, let's just say, at the least. So 2 years in, make the decision. And it's a good idea to be in contact with your real estate professional during this time, because they can keep you informed about market conditions. Maybe they're working with someone where it would be a good fit for your property. You can just get it going very fast if the timing's right. So just be in communication during that time window.
Yeah, and to reiterate really what Josh said, it's going to be market to market, right? So one of the markets that was impacted the most during COVID was condominiums, right? So it might make more sense because the loss that was taken in condos for you to rent it out if you have that capability, if your HOA will allow, and maybe that pencils long term. And again, that's something we can take offline and really try to do a more specific targeted approach to that. But I do think this is incredibly helpful just to consider what does this mean? What decisions do I need to make and how much time do I have? Which again, you have that 3-year window to kind of play around with it until that gain exclusion is up. So yeah, is there anything else we should consider, Josh? Any other thoughts there?
Yeah, there are a few just food for thought items where number one is the Biden administration has its eyes set on increasing capital gains tax rates. So all this modeling that we're doing could go out the window the moment some tax law changes. And it's been a very eventful last few years being a CPA in that regard. And similarly, kind of coming back around to what we were talking about with Washington State, even though the current state capital gains excise tax is excluding real estate, last I checked, that could change in the future. Let's say 2 years down the road, the state needs to find some more money, some more sources of funds. Are they going to target that exclusion? Or are they going to take it away? Well, then that all of a sudden would change this modeling significantly. That's going to come into play. But even if it doesn't, just keep that in mind when you're weighing your options, especially for financing. Are you going to have to sell some appreciated securities that you own? Is this tax going to impact that? Then that starts working through your modeling and penciling out your after-tax cash, right? We talked about 1031 exchanges for rental properties. That can be a great tool if used in the right way and if you are very thoughtful about it. And then also, if you're gonna, with your financing, are you going to take out a HELOC on, say, this home before you convert it to use that HELOC to help you buy your next home? Talk to your tax advisor about that, especially as it relates to the mortgage interest deduction for your main home. There's some complications that can happen there. So that's kind of some food for thought of some what ifs, but I think worth noting.
And I think, Josh, too, one that you brought up that's really important is lifestyle. Like, are you, as a landlord, do you understand what's needed and required from you, especially if you're not willing to do the property management side or hire the property management side to do that? But like unclogging toilets, flooding basements, those types of things, I think sometimes we have to weigh that against the gains and go, is my money better used somewhere else for similar gains or whatever, if my long-term goal isn't to be a property mogul here in Seattle, you know?
Right. It can work out to be great. But again, yeah, it comes down to those qualitative items. And in our industry, we have a saying, don't let the tax tail wag the economic dog. Don't let a tax decision override. It's just one factor in many in a decision that you make. And even not just the economic dog, but just the dog itself. There's more to consider than just tax. So I'm happy to tell you all about the tax impacts and just, put on my tax nerd hat and talk about the code. But at the end of the day, though, that's just one small piece of the overall decision. And I recognize that.
Well, we'll end there. I want to say thank you so much, Josh, for your time. We're going to send out Josh's information. I'm also going to send this recording out to everyone, and I will send a link to a spreadsheet as well, so you can play around with that as well. So that same spreadsheet that we shared, so that you can kind of dink around, plug your equity in. I do want to say, we are again trying to just provide. At the Rise Seattle Group, trying to provide as much information as possible. One thing to be considering if you are considering selling right now is bonkers. If you put something on the market, you get 15 to 20 offers if it's priced right and cute. It's going. And that's across the board in Washington State, from Tacoma all the way up to even Everett. There's just no inventory and incredibly high demand. And part of the reason for that is because of this capital gains exclusion on RSUs and stock options that has recently been created by our legislature, because basically people are trying to liquidate that stock and buy something that is going to hold, more long term, which is a hedge against these types of bets and these types of legislation decisions, which is real estate. So feel free to contact us if that's something that you guys are interested in or kind of processing through. And again, we'll get Josh's information out there to you as well. Thank you so much for joining us. This was a lot of fun. We're going to try to do more stuff like this, because this, we could go super deep into 1031 exchange. We could go there's so many different options here. So if you found it helpful, please send it to your friends once we send this email out. And then if you know anyone who could benefit from this type of thing, and then obviously if you know anyone who could benefit from this type of service, please recommend us, because we're trying to grow our team as much as we can. So thank you. Have a wonderful Friday. It's sunny out. I hope you all get to enjoy it. And thanks for joining us for the first Rise Seattle Group webinar. All right. And thank you, Josh. Appreciate you, man.
Thanks for
Thank
having us.
you.